Hello and welcome to this Friday on Crypt. Oh my God, Bitcoin is just going down. But there's a lot of hope. We have some interesting updates around the industry, and I'm going to hop right into it. Boom. I want to kick this off with my buddy who is looking tired and worn. You haven't heard much about the Roman Storm trial since it did conclude, which, if you recall, had sort of a split decision. He wasn't found guilty or set to go to jail at the end of his trial, but there's definitely a hanging conclusion and a lot of work to be done. So what he says here, final push next week. Our lawyers and experts are working around the clock. We've forgotten what normal sleep feels like. Every hour counts, and so do the costs. Of course, he's asking for help in supporting him on freeromanstore.com, which is, again, a trial around the First Amendment, the ability to use your language to write code. This is about open source, and this is about freedom. Now, he's pretty tired and exhausted. Again, Roman was a developer behind Tornado Cash, which was a tumbling service on Ethereum. There's tumbling services other places, but Roman's whole thesis is that he wrote the code and he deployed it. That does not make him responsible for people who used it. Now, moving on, we have a very hot take in the Ethereum world, which is that Dankrad Feist, one of the primary developers in the Ethereum Foundation and one of the major players in Ethereum updates, leading the take around scaling the L1 and doing manifold updates that can contribute to the growth and development of ETH itself. And he says, I am excited to announce that I'll be joining Tempo. This year has been a turning point for crypto where we've finally seen the outlines of our vision being materialized. While payments used to be at the front and center of the early days in crypto, I see a special opportunity to finally achieve this ambitious goal with relentless execution on both the technical and distribution fronts. And let's recall, Tempo is the stablecoin play coming out of Stripe. Now, Stripe has acquired a wallet development company and a variety of other elements to really put these pieces all together. And what they're looking at is creating a massive payments network unified on chain, revolving around stablecoins, where their Stripe merchants can take advantage of this. I've talked a lot about the normalization of the 2 to 3% of credit cards, and this is combating that. This is a very powerful conversation and honestly resembles a lot of Facebook's DM, which was crushed in Congress. If anyone recalls this, it was a consortium of major corporations that were going to build a stablecoin network, which has now turned into Aptos and Sui, the two L1s. Now, other people are looking at this. This is Nick Allman from Gito. So Gito is actually one of the most prominent protocols in Solana around ordering transactions and maximizing the efficiency of the machine and the costs and the prices. They just received it. And he says, honestly, Ethereum needs to be thinking of counterattack strategies here. People will just build centralized proof of authority chains using the EVMs, steal decades worth of R&D, and then poach all the devs. They are not your friends. And this is what it comes down to, which is that the Ethereum virtual machine, the thing that people inside of Ethereum have been contributing to for years, this is what handles the compute. And you can build another chain that operates with the EVM. It will be able to allow for borrowing and lending on Aave to take advantage of all of the DeFi ecosystem that has grown so enormous on Ethereum. But of course, accessing the EVM does not require you to pay an ETH. It is just a system of compute. So if you're very focused on ETH and its growth, this is certainly a nerve-wracking movement. And this is something that Ethereum and even Bitcoin has a little bit of this battle itself right now, which is that the core developers aren't necessarily being treated as well as these largely funded venture-backed companies. A lot of people get into this for the philosophy of it, but after so many years of not actually seeing value accrual like you might in a well-run business, right? People get older and they want better lives. This is an interesting turn of events to see people from the Ethereum Foundation moving over to places like Tempo, maybe Plasma as well. And this is certainly something to keep an eye on in terms of the health of crypto's second largest network. Now, my second to last take here, I wanted to dwell a bit on Don Wilson. Now, Don Wilson is the CEO and founder of DRW Trading and Cumberland. He is based out of Chicago, and Cumberland has been an over-the-counter dealer for as long as I can remember. If you're looking to sell 7 figures of assets and you don't want to do it on market, they are the kind of people that will facilitate this trade. Now, he comes out with a very useful take on Friday's liquidation event, and this is coming from a traditional finance player who's been in crypto for a long time, and he says, if DeFi is the future of TradFi, what did Friday teach us? And this is, I think, a very meaty conversation to have. He goes on to say, real-time margining keeps things real but needs a check. Real-time margining is one of DeFi's core innovations, which is, of course, that your margin in respect to your trade is available available in real time. This is that 24/7 nature of blockchain. But the market that moves 24/7, it creates new risks to manage. DeFi needs infrastructure that lets you sleep without worrying that you're going to wake up to mass liquidation. And I think this is something that's very real. And it's something that you see when people get deeply involved in crypto. They become a little bit manic and they become stressed because the risk that they take on is very pervasive to their lives. Enter FCMs. Traditional markets would work on batch margining. Your FCM calls, you get a few days to send more money, basically saying, hey, look, you're going to get liquidated. Like, you have a moment to collect some capital and save your position. We've all seen that go horribly wrong, but in a real-time market, they become a credit buffer, the liquidity shock absorber, and the human judgment to smooth the system's response to volatility. Now, he talks about automated deleveraging, which is what happened on Friday. If you recall from my episode, a lot of the platforms went through and they just canceled people's trades. Basically, the shared pot of rewards depleted itself and they had no more money to pay out winners of their trades. So instead, they just automatically canceled people. And this led to a lot of losses or missed gains that should have happened. And here Don comes to say, look, ADL isn't risk management. It's a last resort kill switch. Friday showed us what happened, and he refers to just a lot of people missing out on the action because the system automatically shut them out. Even worse, rumors circulated that some large participants were exempted from ADL. So you have this problematic mechanism, but then if there's backroom deals where you could get wiped on a market event like Friday, but other players can't, I mean, what kind of even system are we creating here? And exchanges can't be all things. In fact, they shouldn't be anything other than a neutral venue for trading. The minute they're providing liquidity or generating revenue from liquidation events, we've passed what should be a bright line. And this I just have to really chime in on, because how can you as a trader really live in a venue where, let's say you have $100 and you're going to take out a leveraged bet against 20 of those dollars. And of course, if it goes down, your total sum of 100 will be lost. Now, let's think about these venues that you're trading on. They can see these positions. They have way more Bitcoin, Ethereum, whatever altcoin it is that you're trading. So if they look at your position and say, hey, we need money right now, we could use that total $100. Not only can they sell their assets on the market in order to liquidate your position, giving them profit, they also have the private keys to things like ADL, where they can also forcibly liquidate you. Let's keep in mind, they're looking at that $100 that you're using as collateral, and that is their profit mechanism. They have multiple ways to take that collateral from you. This seems to be very dangerous, and I do think it's a major issue with the current structuring that we have involved. This is all the more reason to use something more automated, like a Hyperliquid, like a Ruggiero DEX, and to move away from these centralized exchanges that literally profit by taking your money and have the capacity to force your liquidation in a variety of ways. Now, in some hopium news, this is Martin, a technical trader that I follow from time to time, but he does seem to be representing this consensus view that I'm seeing coming from many respectable traders I know, which is that Bitcoin just tapped the range low, offering a clean, risk-defined setups. The assumption here amongst many macro traders is that gold is hitting its range high, that Bitcoin is hitting its range low, and that we should see an inversion between the two assets, hopefully leading to some sort of Bitcoin pump. Now, coming off this $105,000 level that it touched, it does seem that we want to break through the 108,000 to secure ourselves, but the narrative being that there might be a return, that this cycle has not topped, that it is not over, and that there is some bullish expectations coming for old mother coin, orange coin, sweet Bitcoin. Now, with that being said, we learned time and time again how dangerous leverage can be. So as always, I will sign off. Don't over lever. Stay safe. I will see you on Monday, and have yourself a great weekend. Any like and sub would be appreciated. Thank you to all my followers. Have a wonderful weekend.